29%. That number, 29%, is what millions of Americans are quietly paying right now on store credit cards. Not payday lenders, not loan sharks, the store credit card you signed up for at the checkout line, at Target or Kohl's or Home Depot. One moment, one swipe, and suddenly you're locked into an interest rate that would have been considered predatory in any other era. Here's the question nobody's asking. How is it legal? And more importantly, how are these companies getting away with it while their profits hit record highs? I'm going to show you exactly how the store credit card industry has engineered one of the most profitable and least scrutinised debt traps in American retail history. By the end of this video, you'll understand how a card designed to save you 15% on your first purchase could end up costing you hundreds, sometimes thousands more than if you just paid cash. But before we get into that, quick note. This is educational content, not financial advice. Always consult a financial professional for your specific situation. Let me paint you a picture. You're at the register. The cashier smiles and says, "Would you like to save 20% on today's purchase by opening a store card?" And you think, 20% is real money. This jacket is $180. That's $36 back in my pocket. Why wouldn't I? So you say yes. The cashier hands you a tablet. You tap through a few screens in 30 seconds. You get the discount. You feel like you won. And that is exactly how it's designed to feel. Unexpected twist. Here's what they don't tell you in that moment. That store card you just opened. It's not really a rewards card. It's not really a loyalty card. It is a high-interest revolving credit product issued by a third-party bank, backed by some of the largest financial institutions in the country, and engineered from the ground up to generate profit. Not from your spending, but from your debt. The average American household carries about $7,900 in credit card debt. For people who have store cards, the numbers skew even higher, because store cards almost universally carry APRs well above general purpose cards. We're talking 26, 27, 28, sometimes 30% APR. At those rates, a $500 balance that you only make minimum payments on, you will pay that off in over 2 years and hand the bank nearly $200 in interest alone. For a balance of $500, now you might be thinking, I pay my balance every month, this doesn't apply to me. And maybe that's true for you. But here's the twist. The industry doesn't need you to carry debt forever. They just need enough people, tens of millions of people, to carry balances long enough for the math to work in their favor. And it does, spectacularly. Promise of payoff. In 2023 alone, Synchrony Financial, one of the biggest issuers of store-branded credit cards in the United States, reported net interest income of over $5 billion. Billion. From cards tied to stores like Amazon, Gap, PayPal, and dozens of others. These aren't side businesses, this is the business. The retail sale is almost incidental, the real product is the debt. And here's where the story gets really interesting, because the way these cards are structured, the terms, the fine print, the psychological architecture, none of it is accidental. To understand exactly how deep this goes, let me hand this over to someone who's broken down the actual mechanics. Thanks. Let's get into the actual mechanics, because once you see how this system is built, you cannot unsee it. First, let's talk about who actually owns your store credit card. When you open a card at Best Buy or Macy's or TJ Maxx, you are not borrowing from that retailer. You are borrowing from a bank. The store is essentially a marketing channel. The bank issues the card, sets the interest rate, handles collections, and collects the interest. The retailer gets a cut of your spending, a small commission, and in exchange, they give the bank access to their entire customer base. Millions of shoppers, ready-made and pre-qualified by their own spending behavior. Second, how does the APR actually get set? Here's where it gets important. The Supreme Court ruled in 1978, in a case called Marquette National Bank v. First of Omaha, that credit card issuers only need to follow the usury laws of the state where the bank is chartered, not the state where the customer lives. So, what did every major bank do? They moved their credit card operations to states with no meaningful interest rate caps, Delaware and South Dakota primarily. South Dakota eliminated its usury ceiling entirely in 1980. Delaware followed. And just like that, the legal barrier to charging 29% to a customer in California or Texas or Ohio disappeared. Third, and this is the part that most people miss, store cards deliberately target moderate to subprime credit customers. Why? Because prime customers with 780 plus credit scores have options. They'll get a Chase Sapphire or an Amex and they'll pay it off. The store card market is built around the customer who is slightly credit constrained, who can qualify but just barely, who is more likely to carry a balance. Imagine you're someone who just moved to a new city, you're rebuilding credit, and a store card at the furniture place feels like a lifeline. That's the ideal customer for this model. And here's the detail that almost nobody talks about: deferred interest. This is a feature, they call it a feature, offered on many store cards as a promotional financing offer. 0% interest for 12 months. Sounds great. But deferred interest is not the same as 0% interest. It is 0% interest only if you pay the entire balance before the promotional period ends. If you have even $1 remaining on that balance when the clock runs out, you get charged the full interest for the entire promotional period, retroactively, from day one. So you bought a $1,200 refrigerator on a 12-month deferred interest plan. You've been making payments. You have $43 left at month 12. Congratulations, you now owe $43 plus roughly $290 in interest that just activated on the original $1,200. That deal just cost you $333. The Consumer Financial Protection Bureau has flagged deferred interest as one of the most misleading practices in the consumer credit market, and it remains fully legal. Now, some people say, well, read the fine print. And yes, technically the terms are disclosed, but here's why that argument misses the point. The disclosure is a 3-page document handed to someone standing at a checkout counter with a line behind them in a moment of excitement about a purchase. Behavioral economics has decades of research showing that this context, the checkout moment, is specifically engineered to suppress careful deliberation. The discount offer, the social pressure, the time constraint, they all work together. It's not accidental design. It's intentional friction removal at the point of sign-up and intentional complexity at the point of understanding. Let's get into the evidence. Because what we're talking about here isn't speculation. It's documented, it's measured, and in some cases, it's been the subject of federal investigation. According to data published by the Consumer Financial Protection Bureau, store-branded credit cards charge interest rates that are, on average, 8 to 10 percentage points higher than general-purpose cards. 8 to 10 points. On a $3,000 balance, which is not unusual for someone who used a card for appliances, furniture, or holiday shopping, that difference translates to roughly $250 to $350 per year in additional interest charges, every year. Just because you chose the store card at the register instead of a general-purpose card in your wallet. But the most shocking part? The stores themselves are often not even fully aware of how predatory the terms are on the cards bearing their names. I'll explain in just a moment, but first, the numbers. Here's what the documents show. In 2023, the CFPB published a study on credit card profitability. It found that large card issuers, the ones with more than $100 billion in outstanding balances, generated average returns on assets more than 5 times higher than smaller community banks. The mechanism driving that profit? Not merchant fees, not annual fees, interest. The spread between what banks pay to borrow money and what they charge consumers has widened significantly over the past 5 years, and store card customers, who tend to carry higher balances and make minimum payments more often, absorb a disproportionate share of that spread. Here's a specific timeline. In 2015, the average store card APR was around 24%. By 2019, it had climbed to 26.5%. In 2022, as the Federal Reserve began raising interest rates, general-purpose card rates rose. But store card rates? They rose faster, and they started from a higher base. By early 2024, the average store card APR had surpassed 28.9%. That is not a coincidence. Federal Reserve rate increases affect the prime rate, which affects variable rate cards. But banks have discretion in how much of that increase they pass to consumers, and the evidence is clear. Store card issuers passed it through faster and kept more of the margin. Now, about the stores themselves. According to published reporting and industry analysts, many retailers sign long-term exclusive contracts with card issuers that give the bank full control over credit terms, collections, and interest policy. The retailer gets a revenue share from interchange fees, and sometimes from interest income. But they explicitly disclaim control over the card's financial terms, which creates a fascinating accountability gap. The company whose brand is on the card can say, "We don't set the rate." The bank can say, "We're legally compliant." And the consumer is left holding a 29% APR they didn't fully understand they were agreeing to. There have been enforcement actions. The CFPB has taken action against major card issuers for deceptive practices in enrollment, for inadequate disclosure of deferred interest terms, and for misleading minimum payment communications. In several cases, companies paid restitution totaling hundreds of millions of dollars. In most cases, the underlying card products continued to operate. The fine was the cost of doing business. And here's the systemic piece that ties all of this together. The same financial deregulation that enabled high APR store cards in the 1980s also created the conditions for the 2008 financial crisis. The Card Act of 2009 added some protections: mandatory minimum payment disclosures, limits on penalty fees, clearer billing statements. But the Card Act did not cap interest rates. It could not, under the current interpretation of federal banking law. And so, the structural issue. Banks chartered in permissive states can charge any rate to any customer anywhere in the country remains intact today. Here's what this means for you. Not in the abstract, in your actual financial life. Let's say you opened a store card 3 years ago. Maybe it was at a home improvement store or a clothing retailer. Doesn't matter. You got the discount. You meant to pay it off. Life happened. You're carrying $1,800 on that card. At 28.99% APR, making minimum payments of roughly $45 a month. Here's what the math says. At that pace, you will spend 58 months paying off that balance, nearly 5 years, and you will pay approximately $780 in interest on a balance that started at $1,800. You will repay the original amount, plus 43% more. That's not a fringe scenario. According to industry data, roughly 44% of store card holders carry a balance month to month, nearly half. And among cardholders with household incomes below $50,000, the group most likely to be attracted by the checkout line discount, that percentage is substantially higher. Your credit score is also involved here
APR,
in ways that
it takes
aren't
58
obvious.
months to repay.
Store cards typically have lower credit limits, $300 to $1,500 in many cases. That means the utilization ratio on these cards, how much of the limit you've used, spikes quickly. If your card has a $500 limit and you charged $350, you're at 70% utilization on that card. Utilization above 30% starts to hurt your credit score, and you become less eligible for the lower rate cards that would help you get out of the cycle. It's a mechanism that, by its design, tends to keep certain consumers in a more expensive tier of credit, permanently. And here's the future projection you need to hear. If interest rates stay elevated, and the Federal Reserve has signaled that a return to near zero rates is not imminent, store card APRs are unlikely to fall significantly. The structural floor has been established. Issuers have demonstrated they can sustain consumer demand for these cards even at 29% rates, because the sign-up incentive happens before the rate becomes relevant to most people. That behavioral architecture is not going to change voluntarily. The broader systemic issue is this. We have allowed credit products to exist that are specifically optimized for moments of low consumer deliberation, the checkout line, and that generate their most significant profits from the customers least equipped to avoid the trap. Lower income consumers, consumers rebuilding credit, consumers making one-time large purchases, these are the primary beneficiaries of the sign-up discount, and the primary funders of the profit model. That is not a bug in the system, that is the system. But here's the thing, understanding the system is the first step to operating outside it. And there are specific things you can do, right now, today, that change your relationship to these products entirely. For that, I'm going to bring us home. Alright, now that you understand how this machine works, let's talk about how you stop it from working on you. First, the checkout moment. This is the highest leverage intervention point in the entire system. The next time a cashier offers you a store card, you now know the script. You know that the 20% discount today is the appetizer. The main course is potentially years of interest. Ask one question before you ever say yes. What is the APR on this card if I carry a balance? Watch their reaction. Most cashiers don't know. That tells you something important about how the product is designed to be sold. Second, if you already have store cards, and millions of Americans do, here's your action framework. Pull your most recent statement. Look at the APR. Look at your current balance. Look at the minimum payment. Most card statements are now required by law to show you a minimum payment warning, how long it takes to pay off the balance making only minimum payments, and what you'll pay in total interest. If that number is shocking, that's the point. It should be. Use that number as motivation. Third, balance transfer. If you have good enough credit, and I mean a score generally above 670, you may qualify for a 0% introductory APR balance transfer card from a major issuer. These cards allow you to move existing high-interest debt to a new card with no interest for a promotional period, typically 15 to 21 months. Unlike deferred interest cards, and this is critical, true 0% balance transfer cards do not retroactively charge interest if you don't pay the full balance. There is usually a balance transfer fee of 3 to 5% of the amount transferred, but at 29% APR, even a 5% fee is worth it if you can pay the balance off within the promotional window. Fourth, credit unions and community banks. These institutions are not subject to the same pressure to maximize returns on credit products. They are member-owned or locally governed. Their credit card APRs are often 10 to 15 percentage points lower than store-branded cards. If you're in the market for credit, for any purpose, it is worth the extra 20 minutes to check what your local credit union offers. Fifth, understand what you're actually optimizing for when you take that sign-up discount. The store gets a new cardholder. The bank gets a new interest-paying customer. You get a 20% discount, once. In many cases, especially if you carry a balance, the store card costs you far more than the discount was worth within 6 to 12 months. You are not the beneficiary of this transaction. You are the product. Now, none of this means store cards are always a bad deal for every person. If you pay your balance in full every month without exception, a store card with no annual fee and a sign-up discount is genuinely free money. The issue is the system is not designed with that customer in mind. It's designed around the assumption, backed by mountains of behavioural data, that a significant percentage of new cardholders will carry a balance. It only takes a fraction of that to make the entire model extraordinarily profitable.